coming soon of how I'm going to run this show. And so I have some big updates and I'm excited to share them. But first, the Fed came out today at the FOMC meeting and said a 25 basis point hike in the United States, which is going to have some ripple effects throughout the world on real estate stocks and many more. But that wasn't really headline news because there's already a 90% probability he was going to deliver another hike today. I really think that it's one of those things where it was more how he said what he said during the Q&A that really rippled the market. And we saw a pullback from, I think it was plus 8% on the NASDAQ to minus almost a full percentage point shortly after he spoke. And it was because some of the pricing, the bond market and the world, I guess, is pricing in. They're pricing in a pullback. And a lot of real estate agents I follow, a lot of real estate gurus are saying, hey, rates are coming down. Rates are not coming down. Headline news today, rates have gone up and may continue to hike into the future. And there is no plan right now in place to bring rates down in 2023. So for those, and the bond market is currently pricing in rate decreases as soon as the meeting after next. They're going to do a wait and see approach, wait and look at the data. What that means is, and some of the way that they said things is they need to see more pain. And he said it in such an eloquent way. I like some of the way that, like, Jerome is a great tap dancer and he does a great job at trying to stay out of the politics and trying to be, bipartisan and try to be, show that he's, working with the Fed to not create or exacerbate the current banking crisis as more regional banks continue to fail. The interesting piece is there's several more regional banks which will fail. We are at least at the beginning to mid. We're not at the end. There are more banks that will fail. In light of today's hike, there'll be more pain coming. But I'm really excited to see the opportunities that are going to come in the commercial real estate space, specifically in retail, office, commercial. Commercial real estate has very low cap rates in all of the major markets, for the most part. Like you're talking LA, New York, Miami, Toronto, Vancouver. Pick a big, large city, and you'll see the cap rates are quite low. They've predicated most of their cash flow and most of their future analysis on really, really low rates. And a lot of these large loan notes are coming due for renewal. And that's going to create a cascade effect where we're going to see, basically, like if you can imagine the meme that everyone's been showing around, it was like, there was a whole bunch of different doors and there was a Grim Reaper knocking on each door. And it was like, meme stocks, growth stocks, the stock market, residential real estate, commercial real estate's next. And so there's going to be a lot of opportunity coming up, I think, in the next few months, which is exciting. There'll be a lot of default. So I think probably in the billions as far as default goes. And the regional banks are the most exposed to a lot of these losses. So there's going to be pain in the market. Also, anyone who has low rate treasury yields or anything that's fixed in like a 5-year or 10-year, they're stuck. If they ever need liquidity, they're stuck trying to liquidate that at a huge loss now because rates are, say, 8% and they agreed to a 10-year at 3%. And so to liquidate, they have to pay that 5% difference up front for the next 7 years, which could be a 35 to 40% bond loss. So that's pretty painful. It's definitely something that's interesting. I don't know how painful it will be. I know that the credit markets are getting tighter. And so one of the challenges too, especially in the small to mid regional banks, there's like 4,500 banks right now in the United States. It used to be 10,000. They're consolidating. And obviously JP Morgan Chase is going to absorb the majority of it. They now have more than 10% of all deposits, which is against what the federal law was designed to do. But they made exceptions because they were the highest bidder in buying up these smaller banks' bad debts. And the best part of those deals were the taxpayer was going to backstop any losses. And so it's basically infinite profit. Take as much risk as you want. You're now too big to fail. And anything you buy, we're going to backstop it. So it was a phenomenal deal for the large banks, but not so great for the small guy. And what we're going to see is a tightening in the credit markets further now. Every time they increase and the longer that rates stay high, the tighter the credit market gets, which does its job of reducing liquidity in the market, which then results in, unfortunately, job layoffs, contraction in GDP, decrease in credit. And so when these guys go back to renew their terms, they say they had, or they're going to buy a building. You want to go buy a building. They're going to say 50% loan to value. We're not taking any risk right now. Sorry. And so the days of 75% loan to value where you could go into the bank and easily get financing are less and less, and it's harder and harder. That makes it harder for people to buy. So we're going to see an increase in inventory, I think, and probably a decrease in price as a result. Hopefully an increase in cap rates as the market sort of digests the fact that we've now had a year of high interest rates, and we are going to have probably another year of interest rates well above where we want it to be, and potentially staying higher than we had expected or were used to for longer. And so that's going to have some real impacts in the world. And so the first 5 minutes, I just wanted to kind of cover that stuff. As always, throw the comments down below. I'm going to answer them. I am launching something new, and it's coming in the next few months. I'm going to change how I do this stream. I'm going to change it so that the first 15 to 20 minutes of this stream is the full length of the stream. We're going to cover all of the market data, all of your questions, as many as I can get to anyway. And then I'm going to basically end the stream after about 15 or 20 minutes. What I find is the viewership tends to fall off anyway. I know there's 50 or 100 people that are my core, maybe 500 people that really watch it and love it. You guys are still going to stream, but I'm going to also have a private live member Q&A where we can get into some stuff that I can't say online. So we can get into deal analysis. We can get to my honest thoughts on things where I can't be silenced or shut down. I'll be switching it to a Zoom basically. And there'll be some small membership where I'll do that for, call it course members or live members, whatever you want to call it. There'll be a stream for that as well. So that's how I'm going to change this hour. It's the same hour. I'm going to give the same kind of stuff that I always give, maybe a little bit more presentation pizzazz and a little bit deeper into the roots, and we'll be able to do some screen sharing and some other cool stuff in the private stream, but there'll be a public and a private. And so a lot of the guys that are watching right now are my diehard hardcores. So you're like, how do I get a link to this? And initially it'll probably be free. You have to go to my website and you'll type in your email and you'll get a link and you get to go and watch it. Eventually there'll be a membership where I can then afford to pay for services and to improve the quality of it and pay for something like Zoom or something, hosting service. I also am going to be launching some courses, and I'm not a course guy. That's not been my shtick for the last like 7 years. You guys have been following me loyally. You know that I'm not the fake guru guy. I make my money in real estate. I practice what I preach. However, I want to get into the online space, and I want to do it in a way that's authentic and true to my brand and can add value to people's lives. And so I think there is a business here, and there's a lot of people not doing it well, and I feel like I can do it better. And so my hope is that in launching some courses, I'm going to partner up. I'm not going to do it by myself. Partner up with other industry experts, probably share some of the equity, put something together, and probably give some of it back in certain ways to you guys. But if we have a way to generate income, and if you pay a certain amount of money to hear quality content, you tend to take action on that advice more so than when you give it away for free. It's weird, but like as an example, I do a lot of paid coaching. Not a lot. I do a very little amount of paid coaching currently. Like I'll do a call a month. And when I give I used to give them away. When I give those calls away, I talk to someone a year later, they take in no action or very little action when I give it away for free. When I charge people for the call with me, I find they're like, wow, so much value, Mike. Their mind takes better action and they take more attention to it, and they feel like if they don't, then they waste their money, right? So I think in a lot of ways, that's where I'm going to shift. And so I'm announcing that there's going to be two things. One, the Freedom Collective is forming, and it will be a triad between the Bahamas, Florida, and Canada. It will be a membership of people. You guys can join it. You'll have the opportunity to join my Rosehart Roundtable, my Freedom Collective. So that's going to be forming. That's coming soon. That'll be probably an annual mastermind where we meet up and have some fun. It'll also probably be a private Discord. It'll be a place we can all have a community together to cross-pollinate and share off-market deals with each other, do private lending together, just hang out and chill and have that camaraderie. That will pair up nicely with also delivering some quality coaching. By coaching, I mean like someone calls me and says, hey, I have a deal I'm trying to take down. It's a 20-unit building. Help me analyze it the way that you think. So it's me like for an hour coming in like an appraiser, like a JV partner, and giving you that without being the JV partner. So you're paying a fee for that quality content and advice as opposed to paying an equity. So that was also an option. I'm not closed off to the idea, but it's coming. Also, another update. A couple followers of mine have agreed to come on as volunteers to help build this out into something that we can, share with the larger audience, right? Part of it will be like financial freedom and teaching like all the basic stuff around spending less, earning more, and maximizing returns. So there'll be a stock investing course for sure. There'll be a budgeting course with tools and templates that I can give you that I already have in Excel that I just haven't spent the time to refine. And so I can hire someone to refine them. And then if I charge you guys a couple $100 for a course, then it is a business that makes sense. And I can afford to invest in people and give you guys quality products. Because if I don't charge you, I'm just not going to do it. There's no incentive for me to sit down and grind out a course if there isn't some sort of reward. And I can't offer someone else any compensation to do it unless, obviously I have some revenue coming in to pay them, right? So this has to be a business. And at the end of the day, I'm a business guy. So that's what I'm coming with. And the last final thing that I wanted to share was we are coming out with, it's going to be really cool. One follower also volunteered this idea. They're going to build for the Freedom Academy, which is going to go along with the Freedom Collective. The Freedom Academy is going to offer the mastermind level experience. So it's like a mentorship. I've run the mentorship programs before. I have a lot of great mentees that have gone through the program and gone on to have great success. And so that will be a new version of that program. There'll also be courses with the Freedom Academy. There's going to be a chat bot, super cool. The Mike Rosehart Freedom Academy chat bot, which will download every single video that I've released online and know what I know. 600 hours of content. So that's really cool. It's coming. It's going to be bringing AI into the business. So you can ask simple questions like, should I JV on this property? And it will spit out like a really good pro-con list. You could do like, they were beta testing a whole bunch of things, but you could ask the questions like, should I buy this property? And it will run through the analysis of other deals I've done and say, well, no, Mike in the past has said a 25% hurdle rate is what you'd want. They could ask, should I use private lending? And it'll bring up quotes from my video potentially, and search the internet. So that's a really cool integration of AI. And I think that AI is the big buzzword right now. So I want to get into that and share how we can use things like ChatGPT and AI to do the business more effectively. You can use it to do things like write social media posts for you. If you're a real estate agent, it can write listings for you. It can write copy email for you. It can write rental ads for you. There's so much it can do, and so much it can do to make our lives easier as real estate business owners. So that's my plug for that. I was going to share it. I'm wanting to share it. It's coming the next couple of weeks. I don't know when exactly, again, because it's run with volunteer hours, including my own volunteer hours for now, but mostly the volunteer hours of my loyal following base. Okay, so to the Q&A for a second. David says, the free live streams will be greatly missed. Do you see value in radon mitigation in a home that has elevated levels when it comes to resale? Potentially, if it's a real risk for the buyer, if the buyer's really looking at that as an issue, then yeah, you may want to look at saying, hey, there isn't radon, or if you've resolved that issue, then yeah, that would be helpful to attach that. If you have a real problem with that in the house, may not be such a great report to attach. Maybe let them discover that on their own. The free live streams will not be going away, though. To the first part of your question, they will still be here. You will still have a live stream with me every single Wednesday, 7 p.m. live. It'll probably be 7 p.m. to 7:20, and then at 7:20, we'll hop off and we'll jump on to the private members only, where we'll go a little deeper and do some things we can't do in the public. So that'll be really cool. I think it's going to be like a 2-part series. So you're going to get more of me if you're part of this. If you're doing the live stream, you're still going to live stream with me every week. That's not going anywhere. And I may start using the monetization from the Freedom Academy and the Freedom Collective to build out better content on Instagram and better content on YouTube, where we can take snippets of what we do in the private setting and maybe 2 or 3 or 4 weeks later, share that with you and produce quality videos potentially as well. So you will probably get a lot of additional value from this. So it's not a loss, it's a gain. In the grand scheme of things, we'll hit a lot larger audience too, which will generate revenue, be better from our core base who will get more out of me. So Jonathan, hey, how you doing? Good to see you on. John, thank you. William says, evening, Mike. Hey, how's it going? Will, how you doing? John says, good evening. Hello, how are you doing? And then someone said, David says, do you see value in increasing from 1 drive parking spot to 2? Yes, if it's a duplex, 100%, you need side-by-side parking. Tandem parking is not great. The increase in rent, the decrease in inter-tenant conflict is just well worth the money. But 5,000 seems really steep. I would say the hack that I would use is call the city for a curb cut. Oftentimes you don't need a curb cut. You can take it from one driveway if you're deep enough, and you can spread it so that, imagine this is your driveway coming in from the curb. Once you start to come into your property, once it's past the sidewalk, you then widen it to a second lane on a Y shape like this. And I just put down paver stones or often gravel, recycled asphalt. You get recycled asphalt, a load of it for like $600. And you can even ask the guy who's dropping off for a couple $100 cash to rake it in and roll over it real quick. Less than $1,000. I've been able to extend the driveway. I know it doesn't look as nice as maybe like a nice, asphalt or concrete driveway, but it does the trick for most rentals. And if this is not a high-end rental, it's not gonna matter if you have recycled asphalt versus a paved asphalt. And pro tip, you can take recycled asphalt, let it settle, roll it again, and then put diesel on it, and it will harden up into regular, a mixture of diesel on it. It will harden up for like $10 into regular asphalt. So pro tips, lots of tips like that to save money, and lots of things like that I can share into courses. I have thousands of those in my brain. I just want to get them out and deliver them to you in a way that I just can't. If I don't make courses, I can't share all of this. And the best part is, like, if I now have all these courses somewhere and I decide, 2 years from now that I don't want to sell that course anymore, I could give it to you guys for $1. I can give it to you for free if I want to. And I have that there, right? We have all these tools, and I can give it to, if I hire new staff and, someone joins my company, it's like, now they can watch all 10 of these modules. And so there's just so many synergies here with building out, even if I don't treat it as a course, just building out and documenting what I already know and what I'm already doing. I have 1,000 ways to save money, both the personal budgeting side and especially on the construction side. And I know how to, like, 3 of the key modules are going to be about how to, like, basically how do you fund deals, talking about financing and all this different strategies around financing, deals themselves. How do you know if it's a good deal you're looking at? How do you create a deal? How do you analyze it? How do you take it down? How do you wholesale it? All of that, right? Like the whole fundamentals of deals. It's like 6 courses probably inside of that bucket. So you get your financing, your money, your deal, and then obviously your management courses. How do you do good property management? How do you build your power team in real estate? All of that. And like, so there's just, I'm super excited about it. I think it's something that I need to be chasing down. And I'm excited not to be doing it by myself because I have a hard time getting motivated to do that when I have so many other moving balls in the court. So yeah. William says, how levered is most commercial real estate? I'd seem more levered would exacerbate any downturn. Yeah, so I would say that in general, commercial real estate is not super levered. It depends on where you look. So any purchases in the last couple of years would be more levered than purchases from like 10 years ago, 20 years ago, right? So I don't have that data right in front of me, but I remember I was looking at an article and I was thinking to myself, the amount of commercial debt to, and this was like a guess, right? They had like the size of the market and the amount of debt. And I was like, it wasn't crazy. It was like 55% loan to value or something. But even still, a lot of these buildings in like New York, as an example, or Toronto or Vancouver, are like a 2.5 cap rate. And they're predicated on debt in the US that was, at 3%. So now that it's double, it's effectively like you've taken their mortgage balance and doubled it. So they've gone from, if they had a $5 million building with a $3 million mortgage on it or something, it's now like they have a $6 million note. It's equivalent to the same payment cost as having a $6 million note at the old rates. And if their billing was $5 million, their note's $6 million, there's zero chance they're cash flowing. And they're probably not even cash flowing before. So now they're really not cash flowing. So now these boomers are like, shoot, what do we do? I want to retire. Like, so there might be a lot of opportunities to come in and say, hey, I'll take over your building if, X, Y, and Z, we can come together with X, Y, and Z option. And so that's where it can make a lot of sense potentially, especially if you're willing to ride out the rate risk. If you're willing to take on a couple of years of negative cash flow in these big buildings, knowing that rates will probably fall or that you can add value to the building in some way, hopefully both, to increase cash flow, those projects can make sense. So a lot of these commercial buildings are not run well and rent rolls are low and they haven't raised rent in a long, long time. So you can go in there and make it more efficient and do a better job. And so that's where there's going to be a lot of opportunity with those older buildings. I think people are just going to walk away because there's no need. And remember that in the US, mortgages are non-recourse. So you can just walk away. Doesn't even affect you personally. Just walk away, give the keys to the bank, especially if it's a situation where when that starts to happen and values start to fall and you bought the building for 5, your mortgage on it's 3, and we say we get 25% pullback and you get close with fees to sell it and all the other costs associated with that. You get close to break even. You're like, you know what? I'm just going to walk. And now the bank's got a toxic asset. You might be able to go in there, and there's going to be opportunities to go in there and talk with the lender and say, hey, I'll take over this building. There's a $3.5 million note on it. I'll take over the building for nothing. I'll take it over for $3.5 million, and I'll continue to make the payments. I'm a good operator. Here's my backstory, and here's how I'm going to turn this building around for you. The bank doesn't want to manage properties. So when they start taking on these commercial assets, they'll be toxic assets. They want someone just to pay the rates. And so if you go in there and agree and say, hey, I'll give you this new rate that you want on this note that's come due, and I'll continue to run it well. Grant Cardone did this. Many other real estate guys have done this in the past. And there's another opportunity like we haven't had in probably a decade and a half. So I'm really excited about it. I think there's going to be a ton of opportunity. I don't know the size and magnitude of this opportunity. It might not be as big as I'm forecasting. I hope that it is. I hope it's huge, but it might not be. And there's a lot of capital on the sidelines that they printed from 2020 during the pandemic. So there just is a lot of money in the system. A third of all the money that was it's ever in existence, the money supply, was printed in the last 2 years. So there's a lot of excess capital out there, and places like BlackRock have raised a lot of it to come in and soak that inventory up. And so there is demand. So whether there'll be a huge imbalance, I don't know yet. Do I think that there's a huge upside in commercial real estate right now, or in even residential at this point? No, I don't. I think we're at the best case scenario is a slight amount upwards or flat. And that means to me that don't feel like you need to jump in, right? Like if you need to create some cash flow, you can buy deals that have strong cash flow, start cash flowing, you'll be okay, right? Like there's no reason to run away from real estate right now. It's okay to be in real estate, to buy properties, and it's better than being in cash right now. At least you're generating a return on your money. But do I think go all out and lever to the tits and go crazy on real estate that doesn't cash flow well enough? dangerous, right? So just be careful. If you're going to put leverage on a building, make sure that it generates great cash flow. And if it does, awesome. If it doesn't generate great cash flow, service the debt, maybe sell that asset off. There'll probably be a better opportunity just around the corner. So that's my thought on it. I'm continually flipping, continually rebalancing my portfolio through these times so I can maximize ROI. And in a down market, I can still flip and make money. In a flat market, it's my favorite. That's when the best flippers excel. Obviously, a bull market's the best because we make the most money in a bull market, but I like it because the tide's going out right now. And so the guys who aren't good are losing money. I know lots of flippers right now. Lots of people who had 30, 40 properties, like big, I don't want to gossip, but like a lot of big people who were doing a lot of really cool things. All seemed like they were bigger than me even. And it's like they're doing amazingly. And all of a sudden I hear they're going bankrupt and they're defaulting on people. I'm like, whoa, this isn't something that I'm worried about because again, like my core, and I made a post about this today on Instagram, my core ethos around my business model is like cost control. And a lot of these guys didn't have a regard for cost control. They're bringing in contractors at $80 an hour, just spending, both personally and in their businesses. And you can't run a business without really tight cost control. Your deals have to be fantastic. You have to be home run deals. And then you have to manage them well. You can't sit back on a yacht and be partying, having a great time and spending like crazy and hiring contractors and not managing them. And, even if you don't bring in the right contractors, you're going to have problems too. Like there are a lot of contractors who will, job price at $100 an hour. There are also contractors who will charge $30 an hour, $25 an hour. And the difference between them is not big enough to justify a 320% increase in labor, in my opinion. So that's where a lot of these guys are getting burned, is they're overspending and weren't buying quality enough deals. And now they're getting burned as the price falls and they just didn't have the margins. So I look for, rather than a ton of volume, I'd rather have really quality deals. All right. Next question was, do you see PACW after hours complete sell-off? Yeah, I actually made a post about that yesterday, I think. It was yesterday morning? I was like, who wants to catch a falling knife? Maybe that was on Monday. I can't remember. But it's significantly fallen, like 100%. I thought about shorting it, but and I really wanted to, but I made a rule with myself. I will not short individual companies. I learned my lesson on Newegg. I was right with Newegg, but I didn't have the balls to hold as long as I needed to. And with individual companies, it can get crazy. Like it can go more than you can be liquid. So that's where you got to be really careful. And so I don't short individual companies, but I am short regional banking still. The pain is not done. I do think that, so I'll just leave it there. I'll say that I will shorten indexes for the short period of time. I was short the NASDAQ today. So I'm up $90,000. I am short the NASDAQ. I closed that out. So I'm neutral right now. I might go slightly positive into Apple's earnings. I might straddle it. So I might buy longs and sell shorts at the same time. So I might, we'll see. It's hard to bet against Apple. They're just such a powerhouse. And they're now getting into banking amid the crisis. They just raised $1 billion in capital in the first couple of days. So it's interesting to say the least to see how, because Apple's earnings are tomorrow after hours, right? So that'll be, and then Friday we get tons of jobs data and ahead of the next, inflation core PCE report, there's a lot of instability and uncertainty. So I wouldn't take a big position one way or the other right now. Into this meeting, I really wanted, I took a 3-to-1, 2-to-1 short into this meeting for a little bit with the plan to close it out regardless of what happened. I feel this way. The market noise that I'm hearing is like rates are coming down and there just isn't enough pain out there. And I loved the way Jerome was like, look, in our current base case, the way that we see things projecting out, rates are not coming down. And he even said, despite what the markets might be pricing in, they're not coming out. I like that wording today. And I like that finally he said it again. Because every time he says it, it's like no one trusts him. And I feel like he's pissed off that no one trusts him. He has a bad track record of trust. The whole Fed does. But they're really serious about getting inflation down. That's their number one priority over all else. And they will cause ultimate pain to get there. And I like that he admitted that a recession is going to come, because you got to remember that it's always much worse than what they admit, right? So if they say no recession, we're not in a recession, it's not happening, it is happening, just not as bas. When they say we're going to have a small recession, a mild recession, what they really mean is a real recession is coming, I think. So I don't know, who knows? But today it was great. I shorted and then I closed it out. If it hadn't gone my way, might have to hold a little longer, because I think that the NASDAQ is pushing yearly highs. It's up on the 1 year. The year to date was up like 20%. To me, that feels too bullish from current market conditions. So that's why I'm shorting the NASDAQ, is because I believe that tech is a little overvalued right now. AI is a little hyped. AI is a great thing and it's a good tool. It's going to be super awesome. And a lot of people are going to bring it into their businesses in the same way that they brought the internet into their businesses in the 90s. In the same way that we brought Microsoft Excel and PowerPoint, and Microsoft Excel eliminated a lot of jobs. AI is going to do the same thing. It's a tool in people's hands. And so AI is a cool tool. I like it. It's not sentient. It's not, it's just a tool that has access to a lot of information. There's a lot of issues surrounding it with copyright, as an example, because it steals from other people's work and plagiarizes it and then splits it back to you, right? That's basically the essence of the tool. But it's cool. It's doing a lot of great things. And there's, people like Elon Musk speaking out against it, mostly because he wants to come up with Truth GPT, which is his own basically chat bot that, or not chat bot, but his own version of Chat GPT. However, just right-leaning instead of left-leaning, because a lot of this stuff is all left-leaning. It's how it's been programmed, right? It's who programmed it. But anyway, let's go through I gotta catch up on these Q&A because there's quite a bit of Q&A here. I'll go faster, guys, try to keep up. It's gonna be really hard for me, by the way. Like, this is gonna be a real strain trying to get through. I'm not gonna get through all the questions going forward. Like, it won't be next week, but one of these times I'm gonna start doing I'm gonna try to jump off and do the private, members only live Q&A after I do the free one. And hopefully a lot of you guys will jump over with me and we'll keep going with the conversation and go deeper. But it's gonna be hard for me not to answer all the questions, but that's gonna be part of, the reality. As the channel grows, I shouldn't be able to answer all the questions. It's actually a failure on my part that I can answer all the questions in a stream. It means I don't have enough people watching. I should be picking and cherry picking the best ones. Ooh, I got a super chat. Scroll down here and do the super chat. Gleb says, hi Mike, should I major in accounting or finance? Ooh, that's a tough one, Gleb. I would say, both are valuable in business. It depends on your goals, right? Like, what do you want to do with your life? Where do you want to be? What are your interests? Whatever you're interested and passionate about, you'll excel in and you do better in. So I would say go for what your passions are. Do you like studying finance more than accounting? They're both in the same field. Like, in the world of finance, you're using a lot of quant, you're still sitting in Excel, you're still crunching data. Like, I took a degree in finance with a minor in accounting. So I started in psychology, but so I did exactly that. And I went to the Richard Ivey School of Business. It's a great program. I did an internship at KPMG. I did the audit stream and I did tax for a bit. And then I switched over and did consulting because it doesn't pay enough as a full-time job. So when I graduated, I burned the other, I actually had a signed offer with KP for full-time and I burned it for a consulting offer because I wanted the freedom during tax season to do my rentals. Student rentals tended to, so in London, student rentals expire in April and new ones come in May. And that's right during tax season. And I was like, I want to build a student rental business on the side. And I want a job that's going to allow me to get financing and help me save money for down payments. But tax season of being an accountant didn't really align for both audit and tax, but especially tax. So it just wasn't a good fit. And everyone I talked to at the Big Four was like, life is shit during these times. Like, the summer's great, but like, it's shit during busy season. So I didn't really want that life. It was only a means to an end for me, the job, the job. Did it for 3 years full-time in consulting. And then I was able to free myself of the shackles and join early retirement. And now I don't know why I do what I do, but passion, I suppose. And I just like growing and building and it's fun to build businesses, and I like money and I like to make it and I like to win, and business gives me that thrill in life. All right. So to answer your question, in summation, I would say finance, if you're good at it, pays way better than accounting. Finance jobs tend to just pay better than accounting jobs. You need to understand both, I think, to run your own business. So they're both can be valuable. I would say that most of the people I know that have really excelled, like the people I know that were top of their class in finance, are all making $500,000 to $800,000 a year. The people I know who are top in accounting is not really a place that like the high achievers tend to go, but the top accounting guys I know, they make like 120 grand a year. Unfortunately, it's just not a really good paying profession. Though, like, over the long term, accounting can make well into 6 figures, and it's not a relatively hard profession. Pretty easy. It's a bit monotonous, but it can be very synergetic. I know a lot of accountants who go into business later and do really well as entrepreneurs. So accounting tends to be paired really well with going into real estate or building your own business. The finance guys are better at raising capital, I would say, better at taking on big deals. So there's just depends on the skill set you want. If you're not going to excel in finance, then I would do accounting. If you're going to be like middle of your class in finance, you're probably going to do better middle of your class in accounting. But the top quarter of finance grads just crush it. So it depends. It's up to you. You know what I mean? Like I don't know you and I don't know what you're about. So it's hard to really tell you. But I really appreciate the super chat and I hope that can help you a little bit. I would say that, both can be great streams. Depends on what your end goals are. Do you see opportunities in South Florida for multi-rental? Yes, there's of course tons of opportunity in Florida. I've seen a lot of it. William says thoughts on, I have no opinion. Jeff says, be like Gary Vee, charge them for the plan to get there. I for sure could. There could be a financial plan aspect to it as well. And I would love to, I've always wanted to be invested in a business that did some robo-advising because when I started this journey like 7 years ago and I retired, I guess I'm 30 now, but when I retired at 24, 6 years ago, I noticed that like I had been able to save up like $1.5 million or something. I don't remember what it was, but when I was 24, it was not that much money, but it was enough that I didn't have to work again. And I looked around, I was like, no one my age is saving any money. And then I looked a little bit older than me. And I'm like, still, no one's saving any money. And I looked at like the middle class and looked at the society and I'm like, why is the whole world saving like 3% of their income? This is a real problem. People aren't budgeting. They aren't financial planning. They don't enjoy it. They don't care about it. And what you don't, it's a behavioral thing. Like behavioral finance is really the study of financial independence. And it's like, why do people make such bad decisions? It's because if you don't set up parameters for yourself, just in general, the human body, we will eat ourselves more calories than we should. And that actually kills us earlier. One of the longest predictors of living a long time is caloric restriction. So being able to live on a little bit less. If you're supposed to have 2,200 calories and you eat 2,000 calories, you will live longer. It is healthier for you. And so that's just in general, humans tend to be really horrible with behavioral finance, just behavioral in general. And so it's been a interest of mine. I took a minor in it in psychology about studying industrial and organizational psychology. And we studied about how people think through doing things in work and how do you get more out of people just by changing the way that they think about things. And so just in general, I would love to invest in a robo-advisor business and help people because it's monotonous work building financial plans for people and helping them to optimize it and checking in with them and being their accountability partner. But it's necessary. If people don't take the time to sit down and say, hey, where am I spending my money? How am I spending my money? Am I tracking it towards a goal? Have I gamified this in any way? If you can gamify it, make it fun, and help people at least be aware of it and cognizant of how they're spending their money, because people just don't know. Even people like me who are really great in the spreadsheet, I used to track all my spending, I don't anymore. I live a certain lifestyle. I have a certain number of principles that I follow. And just in general, I'm focused on maximization by those principles. And so for me, that keeps me within a float line, like 2 lines of budget. But most people don't have those ramifications, haven't built those behaviors. And I've been doing it for years. Once you do something for a few months, you start building habits, but over a long period of time, it becomes ingrained in who you are. And naturally, I am very focused on abundance. But I've programmed myself through my experiences to have some of that scarcity mindset and cost control because of where I came from. We came from nothing, right? We're broke in poverty, always struggling. And so that was part of what raised me to be frugal. And then I realized that money was the lifeblood of freedom and that I could just buy my freedom. And so now I'm super cognizant of cost control because I don't want to lose what I have. I know what it's like to live in poverty and to have a shit life. And money, to a certain point, predicts whether you have a shit life or not. How long you'll live, how your kids grow up, everything is predicted on a baseline amount of money. If you make the poverty line, life is shitty, just in general. And if you make 6 figures and you spend 6 figures, life's pretty shitty too, actually. So anyway, I would love to invest in a robo-advisor business. And my tangent there is that society is struggling. We need to get savings rates up from 3% to closer to 40%. We need to 10x what people are actually saving. A dollar invested in an economy goes so much further than a dollar of labor. And labor is becoming less and less important, and spending is becoming less and less important. Capital will drive AI and robotics, and we will use machinery to run most of our society. And so there will be the capital owners who have great lives and potentially live forever, and there'll be everyone else, the flesh bags, that become less and less valuable to the superpowers. So just, do you want to be, this is very crude. I don't want to say this in like a rude way to offend anyone, but like, do you want to be a slaver or do you want to be in the top 1% being served? Slaver or served? Because we're grading away the middle class and basically turning into an upper and a lower class society. And with AI, a revolution may not happen. Like someone like Elon Musk in 20, 30 years will have the power to silence everyone instantly. You could release drones that could silence everyone, tranquilize everyone instantly. The entire revolt done. like that. That's the scary dystopian reality of the ultra rich. And so it's a scary time to not focus on saving for the future. And I hope people do. And I hope people build their own UBI through saving. So that's one of my goals. Is I think that the solution to most of these problems is just mastering your own personal finances so you're not reliant on the system at all. Use the system to be free of it. I've been saying that for forever. I want to build some products around that so that I can actually take action and solve this for the world. And so hopefully I can get to that at some point. All right, back to the Q&A. No problem. Happy to always be streaming. Thank you for the positive encouragements there. Looking forward to all the new stuff coming out. Me too. Me too. And I hope we can deliver on all of this stuff. Jeff says, hey, where do you find people? Where are you finding people to help you build this out? So right now, just sending me a message on Instagram. You can send me an email as well, and I can loop you into the Rosehart Avengers volunteer team to build out the Freedom Academy or whatever we're going to call it. Rosehart Insider. I don't know what we're going to call it. Probably Freedom Academy. I like that. If it's not taken, I would like to use that. Tom says, hi Mike, should I buy a house to live in Ottawa or continue renting? It depends. I don't know what the price to rent ratios look like in the area you want to be living, but if you're willing to expand your parameters to where you want to live and say, hey, like if you can live in this spot or this spot, certain areas of the city are cheaper, right? So you can get a cheaper rent. If you want to live in a really not so great area, like a B or C area, you can buy a house and the ratios make a lot more sense. But if you want to live in a really posh area of town or like a good area of town, then the price to rent ratios won't be so great. And sometimes it makes sense just to rent and invest the difference in index funds or real estate investment trusts, or rent where you live and then buy a rental property in a place that you don't want to live, where there's great cash flow. Use the cash flow to offset your rent. And a lot of people who do that in Toronto or Vancouver, where it makes no sense. Like you can rent a really nice guest house for like $1,500 to $1,700 a month in Vancouver. I have a friend who's doing that. And to buy that would be like, to buy that an equivalent, condo or something, they would be paying like $3,000 a month in just carrying costs. So living for half the price by renting. They can take that difference and invest it in an index fund, and they'll be way further ahead, or an investment property somewhere else and way further ahead. So sometimes renting makes sense. I did a whole video on it. If you go look it up, it's actually a good quality video. We edited it really well, me and Kyle, back in the day. Rent versus buy. There's like 2 videos on it, and it's actually a really good YouTube discussion. So go watch that video. It's pretty well polished, and it talks about whether you should rent or buy. And there's actually a calculator that I made. I don't know if it's still available, but there was a link, I think, in the video. Alan says, hey, I have a beginner construction understanding. Would you recommend a residential flip or a multi for a first project? Alan, I think starting small is the better way to go. You manage your risk, you learn, maybe a duplex, something, a little bit smaller is probably the better way to start. But yeah, start small, baby steps, ease your way into things. Don't get in over your head, and then build up as you go. Continue to do more and more deals. Depends on your style too, right? But I would say probably the best way to go. Next question was, why are residential prices in Ontario going up, although rates have been going higher for longer? Where do you see the prices going? So this is exactly what we knew was going to happen. We have a seasonal adjustment each and every year of around 10% from the low of January, December. Usually it's December, and the sales go into January, versus, say, your May high. So what you'll have is your May high, and then in summer it'll start to slow down, in the fall it'll slow down. Same in stocks, everyone sells in May and goes away and does their vacation stuff. Right now is when everyone wants to move because they want to sell their house, buy a new house. Usually they want to buy a new house first, then they sell their house. But they want this to be done, so usually they'll try to find the house they want. Once they've got it under contract, then they'll go and sell their house in the period of when they bought their first house. So they buy their house, then they sell their house. And they want to get moved in with their kids before the school year. So they want to be done by like August. So you get a rush of people who want to buy. And then that frenzy somehow creates, like, human psychology is like, you see a restaurant, it's like packed out the door and everyone just wants to go there. If everyone's doing it, it must be good. And so you'll just see this rush right now. People, mostly it's the spring buyers, but there's also factors like the weather is starting to be nice and we all want to get outside. It's been cold and rainy and horrible. So it starts to be warm. People start going out to open houses. Also, like, just a number of factors. Houses look better when the flowers are all in bloom and the grass is nicely cut and it's not snowing and sleeting and gross. So houses sell for more in the spring. We will see an uptick. That's just seasonal adjustment. So right now, we're not seeing anything that signifies anything more than seasonal adjustment right now in Ontario. But in general, this is normal. You look at all the data. There's a 10% fluctuation between the lows of December and the highs of May. So May, June will be the higher comps, then it will come down again. I think if rates stay higher, although I will say this one caveat. I was looking at some postings the other day about our 2-year bond yields and our fixed rates right now in Canada are actually not that bad. We have pretty low rates relative to some other countries right now. but relative to our current inflation rate, and depending on how the inflation continues to trend, we may see that Canada's doing a really good job of being down inflation. And if we end up being a market leader coming out of this, we may be able to lower rates sooner, and that will have impacts on our real estate prices. But I still think, personally, the bottom isn't coming at least until this December, January. And so don't feel like you need to jump out and buy through this heat. I think there'll be a pullback. It may continue to go up a little bit more through the spring heat into May 2-4 into June, but there will be a pullback, and you'll probably be better off buying in December, January. If you had your one shot of ammo in your gun, you're gonna buy one property. I'd probably wait to buy that property until the fall, into the winter, really. The market is very optimistic, and there's been a lot of pent up capital sitting on the sidelines waiting for a year for things to stabilize because there's so much uncertainty. And I think we're seeing a little bit of a head and shoulders pattern where came down, came back, but it's going to maybe go down one more leg still yet. I don't know. I think the risk of downside is higher than the opportunity of upside. More than likely, we'll just see it be relatively flat with some seasonal demand changes. But it could trend a little bit lower. It could trend a little higher, but I don't really see materially real estate rising, at least residentially. I don't see residential real estate rising, and because commercial hasn't been affected that hard yet. Residential was hit hard, commercial not so much. But I don't think that residential real estate will have as much of an impact because we've already seen a 25% pullback. So how much more, I think the full recession is 30-35% maximum for real estate before there's almost a backstop of the government stepping in Ontario, in Canada in general. Ontario's been the most hit, especially southwestern Ontario. But I would say that's my forecast. And again, it's always changing based on new inputs and information. And we can't stay stuck and say, hey, this is my thesis, and so I can't deviate from it. Any information that comes in, I have to have cognitive dissonance and ignore it. No, it's we do our best with the data that we have. And I think right now, despite we're seeing an uptick, I'm probably going to sell a couple more properties off into this spring heat. And that's okay, because I'll buy more assets as well. I'm going to keep buying. But yeah, that's my 2 cents on it. Thoughts on options trading and selling puts on the S&P 500, like a E-mini on Interactive Brokers. So you're talking about the wheel bait. Look, the wheel strategy is selling puts, and then you sell them deep enough in the money on really down days that you may not get a sign. You might get money for nothing, just selling insurance. But the worst case when you're selling puts is that you may get a sign, that index. And so if you're okay with the S&P 500, then you got to buy the S&P for a 2% discount, which is kind of cool. That's why you would sell put options. Then the idea is, I think in this market, you want to then take, if you do get assigned, you want to also at the same time sell, once you get this shares assigned, sell covered calls on them. And so when you sell a call on it, someone could call your shares away if it gets to X price. So if you say, hey, I want to make a 10% profit on the S&P 500 I just acquired at a 2% discount. So or maybe sell it at a 6% gain, so you're making 2% and 6%. And then you have that insurance. If the market goes down further, you can then close out those covered calls for a huge profit and sell more puts and buy more of the index at a discount. So that's called running the wheel. And you can run the wheel in the opposite direction too. I was running the wheel in the opposite direction where I was selling calls, getting short the index at a discount, and then closing that out using deep in the money sold puts. And that's a great way to collect decay. You collect something called theta decay, and you get money for time. So over time, even if the index moves against you in the wrong direction or whatever happens, you collect money because you're agreeing to buy shares at said price in the future. And that contract gets less and less valuable because the time just decays. So one portion of the value of those sold calls or those sold puts is a potential for uncertainty and change in the future. And so as time goes by, you just win through time. And so that's nice with options. If you set it up right, you can protect your downside, you can collect money just for time. And so time then heals all wounds. And even if you pick the wrong direction, you win in the end through collecting theta decay on those insurance contracts. So if I'm going to use options, that's how I'm going to do it, very carefully. And you really should be the long direction. You shouldn't run the wheel the wrong way. If you're going to run it the wrong way, do it for a very short period of time when things are really bearish. I would say on the NASDAQ at 322, it felt really bearish. It was a great entry point because again, I was 323, I think, on the QQQ NASDAQ. And it's that was up 22% on the year to date, 26% off the December lows. It's that's quite a rally. That was an all-time high in the last 12 months. Probably gonna, even in the hottest bull market ever, you're probably still gonna see, you have a quarter of 22% growth, you're gonna see some pullback. Naturally, even in a bull market in the strongest of years, there's gonna be one of the 4 quarters where it pulls back. So shorting at those levels on the whole index, not on margin, not so dangerous. But continuing to short for a long period of time, you will always lose. The index always moves up. So over a short period of time, maybe, under the right conditions. And again, conditions are pretty shitty right now. So I think I'm right neutral right now, but I may re-engage my short depending on how things go. But I would say, again, like the problem with trading is you don't really have a competitive advantage. It's like with real estate, I can get in there and I can optimize and I can run it like a business and I can make more than my competitors. It's really like the competition in options trading is large quant funds, bots, and then the top, private equity funds. And these guys have really smart people who are doing this 12 to 14 hours a day with access to better data than you. And you expect on your laptop at home with 3 screens and your phone that you're going to outperform them. A whole research house that literally has this team of staff that are digging deeper than you can. You just can't. That's why I don't trade individual stocks. I only do indexes. And in general, I try to run it only in the long direction, excluding certain times like today where I felt like there was a mismatch between what I was hearing the Fed say and what the market was predicting. And again, like I think also looking at overall arching trends, I think for it to be multiple quarters of double-digit growth, unlikely in these market conditions. So I feel like a little bit of a pullback is necessary. Could be wrong. Again, that's why we risk manage. And if we're wrong, we cut and we go back to buying the index. Over the long term, you will always win owning a small piece of the index, but you will not be able to outperform in the same way you can in real estate. In real estate, I can make and have control over my losses, so I don't have a lot of losses, and I can make 100% return. If I crush a big deal, I do a really good job, I renovate it, I get it really nice, get the rents where I want them. The value is based on the income. And so I can take that building and I can make a solid plan of how I'm going to make a great return. In the stock market, I don't have that same control. There's too much, out of my control. In real estate, there's less that's out of my control. There are deals I did, while the market fell 15% in Ontario and I still made money. The market was falling and I was still making money. In the stock market, it's hard to make money when the position you pick goes against you. In real estate, you buy smart enough, you renovate and cost control smart enough, it's a business, you can still make money. So that's what I like about running businesses versus, say, just being all in the market. That said, I like diversification. I still have a stock portfolio. I like to have a little bit of all different kinds of assets. And I also like stock investing is way more passive. Rates are at the same levels they were in 2006, 2007. Do you believe we're headed for more real estate declines in a year or two, which would mean this blip is a dead cat bounce? Potentially. I mean, that's one potential scenario. I don't maybe in some places in Canada and the US. In Ontario, no. I don't think we will see a huge rip down. Maybe another 5. From where we are right now with the spring bounce, maybe a 10% drop, I think is possible. Maybe 12%. That's not a huge amount further down. Is there a whole bunch of upside right now? No. If I can buy property, if the current market value is $1 and I can buy property for 80 cents on the dollar, 70 cents on the dollar, which you can, real estate is extremely inefficient and you can arbitrage the shit out of it. Granny's cousin is selling Granny's house for 70 cents on the dollar and no one knows about it. You go find it on Craigslist or Marketplace, or you can knock doors and find it. That's arbitrage. No one's selling Granny's shares of Apple for 60 cents on the dollar, 80 cents on the dollar, even 98 cents on the dollar. You're not going to get it. They're going to sell at market value because it's a perfect, efficient market. There isn't for real estate. We take advantage of that and we build a business around it. Same in businesses. Grandpa's selling his, his mill or his, online website business. What's it worth? Subjective. We don't know. There's not a fair market price. There's no way you can go and sell those. It's not liquid. So where things are not liquid, you can go in there and provide liquidity and get a great discount. That's what I like about buying businesses. I've bought and sold businesses before. 100% return on one medical business that we did, more than 100% return. And it's a shame that I got out of it because I could have made a 10,000% return. The other partners made more than 10,000% return probably. But regardless, buying and selling businesses and real estate is a business. Just a fantastic way to make wealth and to build wealth. And great way to preserve wealth too. William says, whoa, that's exactly what happened to a couple of hotels here. Keys likely sent back. They went from operating a couple years ago with a name brand to completely offline, name scrapped, just left sitting vacant. Yeah, that's because there's non-recourse mortgages, right? And so these people just walk away. They don't care. They realize that most of their equity is gone. And the cost to liquidate and the effort to liquidate is going to result in almost nothing for them once they pay realtors 6%, legal fees and all of this to get it sold, right? And they break the mortgage and all that. Because you go sell that mortgage to get out of it, the lender's going to nail you in discharge fees. The realtor's going to take 6% of your deal. You're gonna have lawyer selling costs, taxes, everything else. Just walk away. If you got 10% down, let's say you put 25% down the deal, market falls down 15%, you get 10% left in the deal. If you're not a good operator and you're not cash flow positive, if you are cash flow positive, you hold the property. You don't sell when things are their worst. You hold, you cash flow, and over the long term, you always win. That's the beautiful thing about real estate. But there's a lot of people who aren't good at real estate or don't care or have, they work at a pharmacy and they're pharmacists. They don't give a shit about, managing properties, and their property manager doesn't give a shit about it either because they're just trying to nail you for fees. And so it's one of those things where sometimes it doesn't get run well. And that's where we can come in as good operators and exploit that opportunity. That's the cruel business world. Hong Kong Fooey says, how strict is primary residence tax exemption on a rental property or a primary residence where you rent out your basement? I would say if it's not a legal duplex, you're probably fine. If you're renting out like a room in your house, the CRA ruling that I heard from a friend who actually went and asked the CRA and asked for an opinion on it was that their expenses were like $3,000 a month. They're renting a room for like $800 a month. And so their expenses were so much higher, they weren't making any real profit that they didn't even have to claim it. So if it's a small amount of income you're bringing in and you're living there, it's your primary residence, not a problem. Now, if it's a legal duplex, 50-50, technically you're supposed to claim all that income and half of the property would then be not entitled to a primary residence exemption. So if you're gonna do the house hack and looking for the primary residence tax exemption, don't make it a legal duplex. Looks like the trough was this winter. Home prices are increasing now. Again, that's just a thing relative to seasonal pricing and a bit of a bounce coming out of the major pullback that we had. That's natural. It shouldn't just go straight down. That's just not how it works. Human psychology is like people want to buy the dip, right? And also there are a number of seasonal factors that are coming into play. So I don't think it's all the way done yet, and the full bottom isn't in yet, but we're close. And so that means we can start buying again because, again, a 5 or 10% pullback, if you buy smart, the way that Mike Rosehart buys, you'll be just fine. So buy the way I buy, run your numbers really tightly, and you'll be okay. Wow. PacWest is below $3. Wow. PACW is below $3. Dominic says, hey, dude, how's it going? Question, I have one full-time job as a sales job. Commission, I'm closer. Pick up part-time job with full sales job. Hard to say, Dominic. It depends on the type of person that you are, right? So if you're like a really good hustler in sales and you can just close a ton of leads, then full commission, you should make more. The guys that I know that crush it in sales love being on commission, 100% commission, because they make so much and they do so well. How confident are you in your abilities? Usually when you start a sales job, you want to be on base while you're learning, and then you want to migrate to a role that's 100% commission. So I would say when you're learning that industry or learning that company or learning that job or that product, in the beginning, you'll win hard on base because, again, if they're 100% commission, in the beginning, the employer would win because you're not going to be making a lot of sales as you learn the product. But once you get your systems in place and your grooves and your processes and you become familiar, you should be running in base stride if you're a good salesperson. You'll prefer to be on commission because it's much more lucrative for you as a performer. Next question. Savings rate, 50%. Nice, that's great, that's amazing. All good points. So you probably afford to be on commission. Hong Kong says, is it a good strategy to buy cash flow neutral property in Toronto at a discount, knowing interest rates will come down in the future? I wouldn't buy solely based on the fact that interest rates may come down in the future because they might not, in which case you're screwed. So for me, cash flow positive. Unless there's an emotional reason. Like I have people reach out to me like, oh, I want to buy a cottage, and like this is really important to me, and like I want to be on the lake in, Grand Bend or whatever, and it's like the property runs cash flow neutral. Okay, because you get some other benefits that you get to use it once in a while. And so then that can make an emotional case for it, and over the long term you'll win with appreciation. And so it can make sense to be neutral, but I wouldn't, there are better opportunities right now than being cash flow neutral, in my opinion. Maybe there's a way to buy that same property and put it on Airbnb, and you make more cash flow and you become cash flow positive. Maybe you buy near U of T and you turn into you find an 8-bedroom. I see lots of little small 8 bedrooms near U of T where you get $1,000 a room, $8,000 a month. Well, now you're cash flow positive on $1 million property. I seen a property near U of T. Someone was wholesaling for, I think, $1.05 million. And it was like, that's really expensive to me, but it had 8 bedrooms. And I'm like, the rents are pretty high near U of T. You could run a student rental with a nice big TV in every room, do it up really nice, stage it, and rent for $1,000 a room. And all of a sudden now you're in Toronto proper and you're cash flowing. So there's always a strategy there's always a real estate strategy. You can run a business with your property to make it cash flow. Not always, but often. There are many different strategies you can use to make it work. So there's probably a way to make it work. I have spent almost an hour. Geez, it's gonna be really hard for me, guys, to want to cut this down, but I know I can do it. I know that we can take it into 2 different streams, and I know you guys will follow me. I hope you guys will follow me onto the private live streams, and I hope you guys will join us. And there's a lot of people that I know I talk to that want me to mentor them, and so this is going to be part of that. There will be a mentorship level too. There'll be an elite group, probably the highest tier will be like maybe, I don't know, $15,000 for the mentorship program. And that tier out of there, I will select probably some people who I will JV with, who I'll profit share with, who might end up running some of my companies in the future. So there's going to be a lot of opportunity there, and I'm excited for it. So stay tuned. For the people who've been emailing me, I have like 10 of you in my inbox that are like, dude, I'm ready to drop like 15 grand right now to be in your inner circle and to be mentored by you. And so I say, just hold on, it's coming. I'm going to partner up with someone who's also been doing this for like a long time, as long as I have, almost, in this space, and he knows everything I do. And so together, I feel like we can deliver some really great content. And by myself, I'm afraid that I might not be able to. I have some imposter syndrome, like, am I good enough? And I know that I'm a crusher. I've done I've done more than 100 deals, and I've done a lot of different stuff, and I know that I'm good at what I do, but I have back in my head like these confidence issues, right? It's like, can I deliver enough value? Like, and then I go and I watch some of these gurus courses and programs, and I have people send me some of their calls and stuff, and I'm like, these guys don't know what they're talking about. They're horrible. Like, the best of the coaches out there are just terrible and awful. And so many of the courses are so bad that I'm like, if this is the bar, I thought the bar was here. And I was like looking up, like, am I good enough? But if the bar is like here right now, I know I can deliver better than what most of the competition's delivering. And so in that way, I'll be providing net good for everyone, because again, if someone has a course for $1,000 and I can help them make $100,000 in their first year doing real estate investing, and in 2 or 3 years they're retired. I mean, a couple $1,000s, who cares? The grand scheme when you change someone's life, right? When you have that kind of impact. And so it's almost like I can't not do it. I have to do it. And so I'm going to do it. It's going to happen. Okay, so last session you mentioned that you don't see a significant benefit in investing in, say, like Florida versus investing in Ontario. Could you please elaborate on that point? So in general, I don't think that the tax ramifications of investing in Florida are any better than investing in Ontario, except or but for the 1031 exchange. I will say that in general, the corporate tax, the federal tax rates, and the capital gains stuff that Biden's proposing are almost on par with Canada. They're not as bad as Canada, but it's getting really bad. I would say if I was going to invest in Florida, I'd want to do it as an active business. And so I want to be doing some flips. I want to be doing some hotels, Airbnbs, because the tax status all changes when you're an active business with a lot of deductions. I prefer that over a passive business. It's going to get nailed, especially in Canada. So we want to be operating, if you're going to flip real estate, you want to get a corporation going in Ontario. You want to be an active business, getting a small business deduction. You don't need 5 employees to get there. You need to be an active business. You'll have some staff, but an active business is super important. You want to be flipping real estate. And they consider, if you just sell a property in less than a year, you're automatically a flipper. So that's really great. People think flipping is a dangerous thing, but the flipping tax classification is like, you get to be inside of a business corporation paying 12.9% tax in Ontario. That's a lot less than you're going to pay in Florida. So you can run a business more tax efficiently in Ontario than in Florida. And that was the point I was trying to make, was that though I love Florida, also Ontario has no hurricanes, no major storms. There's some pros to demographic trends are both strong in Florida and Ontario. I like them both. 500,000 immigrants coming into Canada. That's huge. Like, every couple of years, we have a million more people. We have nowhere near enough housing opportunity. Florida's the same. The population is growing the top fastest 10 cities. 3 of them are in Florida. Like, Florida's growing also like crazy, again, because people are just fleeing from places like California and coming to Florida. So the demographic trends are strong for long-term appreciation. Though there are some headwinds, I think, in the US right now with some real estate, prices trending a little bit down, the demographic trends, I think, are helping reverse a lot of that. So my thought is that both are great, but it's just not as great as people talk. Like, oh, it's no state tax in Florida. It's like federal tax rates at the maximum are like 28%. It's crazy. Like, there's still tax in Florida in your corporation too. People think it's all tax-free. It's not. So that was my point, was just that Florida isn't all rose-colored glasses. The lending in Florida is expensive as hell. Like, you're going to pay lender fees all in like 8%, 10% interest in your first year. Whereas in Canada right now, you can borrow 5%, all in, lender fees in. You can get stuff that's like on a 5-year fixed for like 4 and a bit, right? 4.99, like no lender fees. So that's huge. Even the big banks comp your appraisal fees even here. Whereas in the US, they just don't do that. They nail you for everything. So there's more opportunity in Florida for sure. And it's a capitalist market. So there's like 20 lenders you can pick from. There's like 5 or probably 1,000 lenders you can pick from in Florida. There's less in Canada. But I don't know, pros and cons. I like both. I'm going to keep investing in both markets. Both have their pros and cons. I wouldn't say one's better than the other. Property taxes are really, really high in Florida per dollar of real estate you buy. Like a $300,000 property here, $300,000 property in Florida, taxes are double in Florida for the same size property. Now, dollars go a lot further in Florida, so you get a lot bigger house per dollar, but something to think about. There's pros and cons, and I want to be transparent with you guys about all that, right? Where would you start? I would go for cash flow. I would go find a small city outside of wherever I live, and I'd start buying properties to cash flow, and I'd niche down in some way on student rentals or Airbnb. I'd pick something and I'd niche on it, and I'd stay in that niche. Don't go outside of it. Like in Florida, my niche is going to be Airbnb. Like I might start buying hotels, but I'm going to build a business around furnished quality rentals, and I may flip. I'll be flipping basically. I buy a property that's distressed. I increase the value a ton, which is basically a flip. Then I may decide to hold it or sell it, and then I run Airbnb around that. So that's a business where I can get extra cash flow. That's the business model. I do similar things here in Ontario, but I'd like to see build a business around it. And a lot of people don't do that. So build a business around it. Build 2 businesses around it. You want to have a 1-2 punch. But if Airbnb doesn't work out, can you pivot? Make sure you always have a pivot plan and a backup. All right, I got to go. I'm way over my time here, guys. There's a lot of great cities to invest in Florida. Go look at like growth trends. Pre-approval in Ontario for 6.8% for a 5-year fix. Jeff, that's really high. Go on ratespy.com. You go spy on what the best rates are. You can get like a 5-year, even a 3-year fix. A couple of weeks ago, we just got one for like, what did I get one for? 5.19, 5.19% 2-year fixed. So like you can get some really great rates. Go look on ratespy.com, Rate Hub. They go and they spy on every single company. So you can see all the different lenders and what they're charging and the rates. So you go in there and say, wow, bring it to your bank and say, why are you charging me this much more? Go to another lender, get a second approval, fight the rates down. All right, everyone, have a good night. We'll see you next week. And in the next coming weeks, I'll be dropping my link to my website. Probably be maybe next Wednesday, I'll drop that. And then in a couple of weeks after that, we'll have the stream. You'll be able to sign up and get your emails going. I don't know how much it'll be. Maybe you guys tell me. Like, let me know in the comments here. If you're watching the replay of this, leave me a comment and tell me how much you think you would pay to be part of those live streams. You pay like $5 a stream. I don't know, like $5 an hour, I guess, for an hour of my time for the private stream. If I then give you some tools and templates with it, would you pay more? What is a reasonable amount? I'll put a survey up on Instagram too. David, I don't know. I think if you're a YouTube member, I might give you a link to the live stream too. I'll think that through. Or cancel it and you go through my website and then YouTube doesn't take half of my membership fee. I'll think that through, but I will not forget you guys. There will be extra value for you also being subscribed on YouTube. And I appreciate a bunch of you guys who are subscribed on YouTube because it's keeping the channel alive, making something. So yes, I will not forget you. We will find a way around it to get you onto that as well. So you will not miss out on those. You may just have to pay me directly because we'll probably have to do it through Zoom, I think. So don't worry, I won't forget you guys. Won't forget you, David. Won't forget you, Jeff. All you guys who are paying for my YouTube membership. Maybe we just won't pay for YouTube. We'll pay for something else. Or I'll get you access. Don't worry. Won't forget about you guys. You guys have my email. You know how to find me. As always, the secret to unlocking a wealthier you. 3 levers and control your financial future. Spend less, earn more, and maximize returns in the difference. Bye, everyone. See you next week.